Alright, this tutorial is going to show you how to trade in Investopedia. So once you created your account, you're signed in, you're ready to go. It says, hi, Jane Navickas. Here it is up here. We want to make sure we go into the simulator, make sure we're in our trading game, and we're ready to trade. So right now I'm in Intro Spring 2013. And so I've decided what stocks I want to buy in this portion of the game. And so what we want to do is to trade, we just click on the trade button and it will pull up basically the trading screen. And really any type of brokerage account online kind of works this way, minus obviously all the ads over here. But let's say right now I want to buy Apple. I need to get the ticker symbol. I know that Apple's ticker symbol is AAPL, and for the transaction type, we could either buy it or we could sell the stock if we own it. If we think the stock is going to go down, we're going to sell short. And then also a more sophisticated cover would then be to buy to cover. Once we sell it short, we want to cover our short. But shorting is a little bit more riskier for the average investor. Shorting is where you think the stock is going to go down. You borrow the shares from someone lends you shares, and basically you own them shares back. So when you borrow those shares, you sell them at the current price, and then you buy them back at a cheaper price, and thereby, keeping the difference between the price there. But in your instances, we're going to mostly be buying here, and then it's going to ask for quantity. So in here, we want to obviously come up with a dollar amount, and we want to divide it by what it's trading at per share. So right now, Apple's trading at $420 a share. Let's say I want to invest $5,000 into Apple. What I do is I take the amount that I'm investing, so in this case $5,000, and I want to divide it by the price per share. In this case, it's $420. So I divide it by 420, it's going to give me how many shares I want to enter in. So here it's 11.9. And that might not seem like a lot of shares, but you got to remember Apple's also trading at $420 a share. So when it comes to stock price, this is a higher price stock. Higher price doesn't always mean a better stock. It just means that the company decided not to split the stock at all. And so that's kind of up to you to look at the price and the range and where it's at. So here I'm going to just round up to 12 shares. So I'm going to come in here, I'm going to buy 12 shares of $4.90. Now, market order is going to put the order in at what the last bid price of the stock was. You run a little risk here when you use market orders. I prefer to use limit orders, and what a limit order is the maximum amount that I will pay for the stock. So right now it's trading at 420. Let's say I think Apple's going to come down a little bit. I want to buy it at 400. So I'm going to put a limit order at 400. If you want to buy it right now, you go with a market order. But let's say I think Apple's going to fall to 400, and I want to buy it at 400. So 400 times 12 would give me a trade of $4,800. And then for the duration of the order, you could do a day order, so the order only stays open for the day, or it will keep the order in until you cancel it. All right, so then once you do that, so just to recap real quick, you need the symbol, you want to buy, the amount of shares, and I showed you the calculation, take the dollar amount divided by the share price per share, comes up to 12. There's my limit, 400. If I want to just buy it what it's trading at currently, then I want to go with a market order, and then I'm going to preview the order, and here we go. So here is the trade. And remember I said 4,800, and you got to remember there's a commission every time you buy a stock and every time you sell a stock. You have to pay that commission. So the commission, for this one I set at $9.99. So once I like that, I'm going to hit submit order. And let's see, drum roll, and here we go. The order has been put in. And it tells me the buy limit order for Apple was received. And that's really how simple it is to buy stock. You just need the symbol, the shares, and the type of order that you want executed. So now basically what's going to happen is the market's, the next time the market opens, right now the market's closed, we're in the evening, that order will stay in, and as soon as Apple hits $400 a share, it will execute that trade. Now, you run a risk there. What happens if it jumps to $600 a share or $700 a share and it never reaches your limit order, well, you just miss out on that trade. So as an investor, we got to look at, are we in it for the long haul? Are we trading short term? And we have to kind of come up with a philosophy and a system for trading. In my investing class, we really create a system for the students on how to trade stock, how to evaluate, and then basically then we also get even more complex when we get into what's called options trading, which means that we control the right to buy and sell stock at a certain price. And we call this a contract, an option contract. I have the option to buy it or sell it at a price that I enter into contract, and I do not have to buy it or sell it at that price unless I execute my right. And so we study that, but that's getting a little more complicated for a basic consumer economics class. But remember that option is out there for you. All right, so that's basically the long and short. Now, once I hold the stock in my portfolio, if I want to sell it, I could kind of do the same thing. And so let me just go back to the trade screen real quick. Let's say I'm holding Apple now, and Apple is just doing a bang-up job. Let's say it gets to $500 a share. Then I want to sell. I want to sell my 12 shares, and in this case, let's say it gets to $500. I bought it for $400. It gets to $500. I own 12 shares. I just made $1,200 there. So I want to protect some of that profit. So what I could do is I could put a stop order in, and so when it reaches, if it were to reach, let's say it gets to 400, when it gets to 390, I'm sorry, it gets to 500, if it were to get to 490, I would want to sell it. So I'd put a sell stop and then down around 490, and then that would basically execute the trade. If Apple were to start falling and it gets to 490, therefore I lock in a profit of $90 per share at 12 shares. That's 1,000. What is it? $1,080, something like that. I just did some quick math there. You could check me. All right. So let's say I just want to sell it. I want out. Then I just, like I did before, I did market, or I could do a sell limit order. Let's say I bought it at 4, and it's kind of the same risk you run. I want to sell it when it reaches $5.50 a share, and so the trade will sit there until the price reaches $5.50, and then it will sell, locking $150 a share profit. But what happens if the price never reaches $5.50? So you run those risks just like on the buy side. On the limit order, you run the same risk. Another feature when you go to sell, you could do what is called a trailing stop. A trailing stop is nice because it's not. Oh, there we go. A trailing stop, once it reaches the price, it takes the price that it's trading at. So let's say my example, Apple trades up to 500 a share, and I put a trailing stop of $10 in. What that means is it will take the highest price it gets to, starting from today. It will once it falls below $10 of the highest price it gets to, it will sell it off. So for example, if it's trading at 5 and I put a trailing stop of 10, I've just told the computer it's going to trade the stock when it gets to 490. Now let's say today it jumps to 530 a share, so it had a huge swing today. It goes up to 530. Now the trailing the sell order gets set $10 below 530. So now it's going to trade at 520. So it's sitting at 530. If it were to fall to 520, it sells it off because it's $10 from the highest price it reaches once I put that order in. You got to remember though, with a trailing stop, that it might drop that 10 and then all of a sudden it shoots up 100. And it's happened to me before. I put a trailing stop in, I lock in my gain, I get my gain, and all of a sudden, boom, a few days later, it jumps $40 a share. And that will happen, but that's part of the risk-reward scenario. So there you go. There's how you could, here's some basic trade options. So have at it, have fun with it, see what you can do.